Welcome back to Turning Hard Times to Good Times. I'm your host, Jay Taylor, and I'm really pleased to have Doug Noland with me once again. Doug has been not all that frequent with us, but so maybe I should just let those of you who may not be familiar with him know something about him. He is currently the portfolio manager for the tactical short strategy at McAlvany Wealth Management, and previously he served as senior vice president portfolio manager at Federated Equity Management Company, overseeing the Prudent Bear Fund, where he worked for quite a few years before that with David Tice and Associates, who ran the Prudent Bear Fund. And I've learned to know Doug over the years as a very honest, straight-shooting, very, very smart guy who's really gets in the weeds, I would say, which is necessary. He really pays a lot of attention to detail and puts out a very prolific weekly. Well, I'm familiar very much with his credit bulletin that he puts out weekly. I think maybe even more frequently than that. And I would suggest, I believe it's a free of charge publication that you can get on the internet. It's at just go to creditbulletin.blogspot.com, I believe. Doug, thank you so much for joining me today.
Hi, Jay. Thanks for having me back.
It's really good to have you. And I wonder that creditbulletin.blogspot.com, where you write so frequently. I'm used to looking at it occasionally on weekends, but it looks like you do more than that. Like you're within the week, you write some things too. Is that right? Almost daily?
Well, you know what I try to do, Jay, is during the week, I have a day job, a demanding day job. I just try to have important links for people that they can come and see important news stories. And I do that at creditbulletin.blogspot.com and also at the MWM.com, our McAlvany Wealth website. Yeah. But mainly I post on really late Friday nights into early Saturday morning is when I post my weekly piece.
You work very hard, no doubt about it. And there's a lot of great stuff there. If you want to sort of get a summary of what took place during the week, I would suggest that's a great place to go. Doug, I'd like to start out by asking you, this is a question that Adam Taggart frequently asks his guests when he starts interviews with them. I've really come to enjoy Adam Taggart's Wealthion. He has a lot of really great guests on there. And he always asks him, what's your assessment of today's economy and financial markets? So sort of a big, 30,000 foot up question. What are just sort of an overview of how you see the markets these days and the economy?
Sure, Jay. My assessment here, the economy and markets, and let's start big picture, as you were saying, top-down macro. Mm-hmm. So I started my blog, it's been some 24 years ago. The years fly by.
Yeah, they sure do.
And I titled it The Credit Bubble Bulletin because I was convinced back then that there were momentous changes in finance and policymaking that were fueling dangerous bubbles. And early on, I guess I was naive. I thought the Fed, once they came to understand the nature of unfettered non-bank credit and leverage, this new financial structure, and I referred to it as Wall Street finance, our central bank would move to rein things in. It was highly unstable finance. Well, I was dead wrong on this. It's been a couple of decades now, and the Fed and global central bank community, they've gone to previously unimaginable extremes to support and backstop and bail out this new financial structure. If you think about it, zero rates for years and tens of trillions of QE, all the money printing. And they repeatedly bailed out the markets, re-energized bubbles. So my big picture is, the result has been the greatest bubble in human history. I know it sounds hyperbole, but I've done my best over the years to study history. There's been nothing comparable. This bubble went to the heart of money and credit, central bank credit, government debt. It went global. There's no new, bigger bubble coming. Years of excess bubble excess. It deeply distorted structure, and that's the financial structure, the market structure, and has left us with this deeply maladjusted economic structure. So my assessment, unfortunately, is quite negative, and I often say I hope I'm dead wrong on this. But as an analyst of credit and bubbles, I'm certain of one thing. They inevitably burst. The bigger they are, the more destabilizing their collapse is, and that's for the markets, for the economy, for societies. And while we're early in the bursting process here in the U.S., and actually things are much further along in China, and I spend a lot of time following Chinese developments. It's one of history's greatest speculative bubbles, and it's just collapsing, and the world's never experienced anything like China's apartment bubble. Mm-hmm. And now, we see the real estate developers, and these are huge companies with trillions of liabilities, and they're collapsing. So this is going to have, major financial, economic, and I fear geopolitical ramifications. As far as the U.S. economy, so far, it's been generally resilient. Markets have suffered this year, bonds and stocks. And this doesn't get enough attention, Jay. System credit growth has remained strong, and this is really important because this strong credit growth has supported economic activity, but it's also been inflationary, and there are cracks developing, but so far the credit bubble here in the U.S. is ongoing, and I believe the record bank lending, I don't think it's sustainable. So I'm quite negative on U.S. market and economic prospects, unfortunately.
Yeah, that's unfortunate. It's right, but it seems as though we were talking to my first guest a moment ago about there are limits to everything. It's like I think Ray Dalio has picked up on this very well. That in fact we can't keep pushing the can down the road, kicking the can down the road. That his sense is that we've gotten to the point where we just can't, the system itself can't withstand more and more of this. You see it that way, that we might have some sort of a major reset?
Yes, I do. And I mentioned that this bubble, it went global. It went to the heart of money and credit. We've had these bubbles over the years. You can go back, you can go way back, or you can just go back to the late 90s tech bubble. When it collapsed, then we reignited bubble excess into the mortgage finance bubble, which was a bigger bubble. Mm-hmm. And then when that one burst, I started referring to the global government finance bubble. So we're at the end of the line for places to look for bigger bubbles or new financial instruments. We've gone to the heart of money. We included China and the world in this bubble. Mm-hmm. And we're to the point now where, the money printing is resuscitated bubbles repeatedly. We're to the point now where this money printing has led to and will continue to lead to a very problematic inflationary environment. So, Jay, I am convinced, and I think it's important analytically, that we've ended the previous cycle. We're now starting a new cycle, which will have very different dynamics.
I'm wondering, China reportedly, from sources that I trust, have been importing massive amounts of gold. They are supposedly the largest gold producer in the world, at least had been. Russia, the same thing, has reportedly built up their gold reserves very dramatically over the years. And just today I was just reading an article talking about how they have now started digital trading, excluding the U.S. dollar, that is China and Russia, together. Do you make anything of that? Do you see that as part of a, I think Xi Jinping has made no secret of the desire to lessen the role of the United States dollar in global trade. Do you see that as something on the horizon, a new currency regime of some kind?
Yes. It's the old, the enemy of my enemy is my friend. And that friendship with our partners without limits between Putin and Xi, mm-hmm. I think that the goal there, the reason these two are coming together is to develop a new global system outside of U.S. dominance. I think that's clear. They've articulated it. I think some people have been dismissive of it. I think they're less dismissive now. That will be an unfolding story over the coming years and decades. Is this bipolar world for finance, for trade, unfortunately also probably for hostility and conflict. But I think definitely there's another system being developed.
Are you surprised by Jay Powell's Resolute, his determination to really hold tight on, hold the monetary system tight, to hold his tight policy? I mean, I think a lot of people figured as soon as the equity market would start to decline, we'd have a new QE. Are you surprised by his sort of resolute standing on this issue?
No, not really. I think Powell, when he came in and became chairman, that he wanted to change the direction somewhat of the Fed and quit bolstering the market so much, et cetera. He understood that that was unhealthy. It led to instability. He let me down. He let everyone down because he bowed to pressure from the markets relatively quickly. He started QE again in the summer of 2019, which was a big mistake. And I think this $5 trillion of pandemic QE was it's indefensible. It was a terrible mistake. Mm-hmm. But I believe he recognizes how dangerous inflation can be, and they have the fear of God in them right now. Mm-hmm. Does that mean, I've said as much, I've written as much, I expect more QE from the Fed. I absolutely. When the markets get in serious trouble, de-risking, deleveraging, they're the only buyer of last resort with the liquidity necessary to keep the system from collapsing. But he also knows that he's got to be serious about this. He's got to make the markets know he's serious. Coming out of the July FOMC meeting, his press conference was viewed as leaning dovish, and that stoked a market rally, and that rally led to a loosening of market conditions, financial conditions. That works against what the Fed is trying to do. So I think right now he has resolve. He knows the danger of inflation. He knows that he can't think Wall Street, or he can't allow the markets to think that he's going to bow to instability quickly. He's doing what he needs to do so far, and we'll see how long he can maintain that resolve.
Yeah. I mean, it's just, you have to think that if something breaks very seriously, but it seems as though from his statements that he sort of believes that being too loose, loosening up and doing, stopping Q tightening too soon could be a bigger problem than tightening too long. I think he more or less said something like that, to that effect, because he seems to think we've got the tools, we can jack it up again when the time comes. But do you think that he doesn't want to crash the economy, but if he does crash the economy, he figures he can always get it revved up again? Is that the way you read him? Yes, and that's right, Jay. And he made this important point. He actually made it twice, and I thought is very interesting. He sees more risk in over tightening, in not over tightening, and in not tightening enough. So his view was, and he articulated it, if they tighten too much, they have the tools, they can back off, and they can support the economy and the markets. If they don't tighten enough or reverse tightening early, they risk this very problematic inflation that's, gets to the point where it's very difficult to control. And, if I read Powell correctly, he understands this risk. And I mentioned the risk of the markets responding to any dovishness from him or Fed officials. So I think he's got a pretty good understanding right now of what he needs to do. I think, though, that the Fed might be lulled into a little bit of complacency here, that the markets have come down significantly, but it hasn't led to systemic issues. And I think part of this, and I've touched on this, part of this is that we still have, basically
outside of 2020, we have record credit growth through the first half of the year. You have very strong bank lending, very strong private credit. So that has supported the economy, supported liquidity, supported job creation, investment. So market weakness hasn't had the impact it would have had previously because of the aggressive banks and private credit. I think this is temporary. I don't see the bankers being able to maintain this level of lending going forward.
Well, you have to wonder to what extent this 7% mortgage isn't going to start weighing on the housing market, which is such an important part of our economy. You have to wonder, unemployment lags quite a while after tightening takes place. If 2023, what's your outlook for 2023? Do you think we head into a recession next year? At the same time, what you just mentioned, the resiliency and credit growth and so forth, that's reason for Powell to keep the brakes on, essentially, it would seem.
Right. And gee, if I could stress any point here for listeners, there's a lot of nuance here. This is not a normal environment. And housing is a great example, right? We see 7% mortgage rates and even higher for jumbo mortgages. But at the same time, we have very minimal inventory out there. This isn't like previous cycles. So housing prices haven't really started to come down yet, even though mortgage prices have spiked and a lot of people are priced out of the market. We've started to see inventory build a little bit, but I think it's just going to take time. And when it comes to housing, I ponder about, how much speculative excess we have out there. How many homes were purchased for Airbnb, second vacation homes, adjustable rate mortgages, low down payments. I think there's a huge issue unfolding in housing. I think the downturn has begun, but it's just going to take longer than normal, longer than we would expect because of this, inventory issue. We've also had huge institutional buying of homes. That's a big unknown. Do those institutions become sellers, or how much longer do they continue to buy? So as far as 2023, I think the economy does succumb to recession. I think housing becomes a real concern, and a concern for sellers, buyers, investors, bankers, and the Fed. The economy weakens, but the economy, like housing, has nuance also, and it's just going to take longer than we would normally expect. Again, financial conditions, my focus. Financial conditions have tightened in the markets, but they remain really loose in private credit, in bank lending, etc. So this is not a normal cycle to try to analyze.
Well, then one wonders how effective the Fed will be in taming inflation then. And of course, also given the fact that so much of inflation has been caused by supply side considerations, geopolitically related, a lot of them. And, policies by our administration with respect to this hostility towards hydrocarbons and so forth. Do you think that in 2023 we'll see some progress in taming inflation?
Well, my own view is that the Fed thought what they would end up doing is just, raising rates, the markets would tighten, and that would start the, weakening demand, weakening the economy, weakening price pressures, and they could get through this without, a real tough tightening cycle. They now realize that's not the case. Part of it is because credit growth has continued to run strong. A lot of it is the inflation issues are structural, supply issues, and I think they recognize a lot of these issues are not going away anytime soon. Globally, climate change, a lot of factors out there are pressuring prices higher for this new cycle that we were not issues at all in the previous cycle. So everything points towards the Fed having to hike higher than they would have expected, which increases the risk of a market accident. That tightening until things break, and it's really a problematic scenario that's unfolding, I think.
Well, you manage on the short side of the market, I guess, and how are you handling this?
Yes, tactical short, what we're trying to do is just be a market hedging vehicle. It's separately managed accounts at McAlvany Wealth Management. We're trying to have manage risk very carefully. So we're short the market, but we're doing it cautiously. I'm not short individual stocks today. I'm short the S&P 500 for a few reasons. I'm not 100% short. I'm call it 78% short. So I'm trying to be a hedge without taking the risk because we know there's going to be these big bear market rallies, a lot of volatility. Again, this is not a normal market environment. A lot of nuance in market analysis also.
Yeah, for sure. I mean, there's a lot of funds that have not been fully invested that need to be pretty much fully invested by the end of the year, and I think there could be some things that could cause the market the equity market show some strength. But I have to ask you, with just my engineer says just 2 minutes, what do you make of the move in gold and silver today? Is it anything other than just an anomaly?
Well, Jay, I think it's more than an anomaly. So far this year we've seen this environment, and I think it's part of the news cycle where hard assets are outperforming financial assets. And I think part of this is, the geopolitical environment. Central bankers for the previous cycle, they could just focus on financial markets, on stock prices and bond prices. That was their focus. Well, now with inflation, they can't just focus on the markets. They have to focus on inflation. So this is changing dynamics out there. So I think hard assets will continue to outperform financial assets, but we had a pullback in the precious metals and some of the commodity prices because of dollar strength. I think a lot of hedge funds, speculators got caught on the wrong side of these markets. A day like today makes me think, okay, we see a little dollar weakness. There's a lot of pent-up demand, and maybe people that have been waiting to start adding to their metals positions are now starting to do that. That's kind of my read on the market today and the nice move in the precious metals.
Well, it certainly is welcome for those of us that have been long the precious metals, that's for sure.
Absolutely.
Doug, I want to thank you so much for coming on and spending some time with us. And it's mwealth.com. I guess is where people can go really to avail themselves to learn how they might take advantage of all that you have to offer at McAlvany Wealth Management and your insights as well into the markets. It's greatly appreciated. Thank you so much, Doug, for being with us.
Thanks so much, Jay. And it's mwealth.com, and a real pleasure to be with you today. Thank you, sir.
Absolutely. Thank you.